Okay, back at it, back to the Ray Dalio stuff about debt cycles and where everything is headed. The world order, the changing world order. We are finally at the end of chapter 2, such a long chapter about money, credit, debt, and the economic activity. So you guys remember the last part was the long-term debt cycle in detail, which I'm about to recap quickly here. But before I do it, remember, free training that teaches you the exact strategy I use and all our Fallible members. Definitely check it out. There's a link in this video and down below in the description and comments. It's very important to get your strategy in place as the order keeps changing in the world, I guess you could say. But markets change and your strategy needs to account for that. Check it out. Okay, so the long-term debt cycle, the way it interacts with money is in 3 different phases. Every society or economy, you could say, starts out with hard money, which is metal coins like gold. So people will be trading gold coins with each other for services and goods. Then they go on to paper money. So they keep all the gold in the bank and they issue paper saying this amount of paper is worth this much gold. And then they finally move on to fiat money, where the money isn't tied to gold or anything. It's just tied to the credit of the government that's printing it. That's where we are today. So the hard money system with straight up just coins is the most restrictive because you can't create new money unless you dig up more gold or something. Money and credit are easily created though in the second type of system, which is why people move to it, or not people, but societies. Because now you have all the hard money or the gold in the bank and you could print the paper money saying this much paper money is worth this much gold. And you could change that ratio, so that gives you some leeway. So is it $50 to 1 ounce of gold or less? But eventually this leads to a run on those banks because they end up printing too much and people think, hey, I might not get my gold back because there's just way too much paper. So this results in defaults where the banks have to close their doors and everyone loses out. And also devaluations, which means, like I was saying, the money is worth less, so depositors get back less. Then finally they move into the third type of system where you can just create as much money and credit as you want and it continues to work as long as people have confidence in your currency and your system. So it's all faith-based. So throughout history, every country has transitioned through this in a logical process because as a country needs more money and credit than it currently has, because they end up piling up debts, they have a few wars and other problems, they move from type 1 to type 2 and then 2 to 3, basically giving themselves more leeway to print every time. But eventually, once you're in type 3 like we're doing now, you just print way too much. The money devalues, any debt held in that money devalues as well. So people end up dumping it all and they lose faith in the currency. And then that's when they turn around from that currency and head back into hard assets. So they go back into the stage 1. And this usually happens with some wealth conflict, like a huge wealth gap between the rich and the poor, and there's a war usually. And most people want to leave that country. So that's why the country has to go back to some hard currency standing to help people gain faith again in them. So you basically keep going in this cycle. Hard money to claims on hard money to fiat money and then back to hard money. That's the cycle. Now this whole money cycle that fits with the long-term debt cycle happens every 50 to 75 years. That's the total cycle term. And the end of these cycles usually happens with a big debt restructuring and a change in the monetary system. Now those restructurings themselves happen pretty quickly. They only last a few months to up to 3 years. But the effects of them are very long lasting and they could lead to a change in the reserve currency. So during this period of one currency having that power of being the reserve, there's typically 2 to 4 big debt crises. And they're big enough to cause banking crises and debt write-downs and big devaluations of the currency, but they don't break the system. But eventually, the system does get broken. So in the system that we're currently in, the dollar is king. It's the main reserve currency. And that happened after the end of World War II. So the important thing to understand is that there's huge power in being the world's reserve currency because you're able to print as much of this currency as you want. Other countries can't because only the Federal Reserve can print dollars, right? But those dollars are widely accepted everywhere as a medium of exchange and a storehold of wealth. So whatever country has this reserve currency, their financial economic power is multiple times the size of their real economic power because you could do a lot of stuff with the printing. So that new world order with the dollar on top began after the end of World War II in 1945. And this made sense because near the end of that world, the US had around 2/3 of the world's gold reserves and they accounted for 50% of the world's economic production. Plus they were the dominant military power. So that's why dollar was king. And this monetary system was a type 2. So there was gold in the bank and then there was dollars issued on that gold. And there was a fixed price of $35 per ounce of gold. And during this time, it was illegal for individuals to own any gold themselves because governments didn't want to compete with, their ability to create money and credit. So when they established this new monetary system, there was $50 of paper money in existence for each ounce of gold the US government owned. So there was a nearly 100% 100% gold backing in the beginning, so it was tied very closely. But of course, over time, the US Federal Reserve created a lot more claims on the gold. They printed more money, and there was way more paper than could be converted into gold at the $35 price. And as this was happening, the smart people were taking their gold out of the bank. The quantity of gold in the US bank went down at the same time as the claims on that gold continued to rise. So you already know what's going to happen, right? We're about to switch to system 3, fiat money. So the Bretton Woods monetary system, where we were linked to gold, broke down in 1971. Nixon took us off the gold standard. And what happened was that the dollar devalued against gold and other currencies. So this is when all of us, the US and every other country, went into a type 3 fiat monetary system. So now that we were in fiat, we were free to print, right? So the Federal Reserve and the central banks created a bunch of money and credit, which led to the crazy inflation in the 70s. And during this time, everyone was jumping out of dollars and trying to get into other stores of wealth like gold. And the panic out of dollar and dollar-related debts also led to interest rates shooting higher. And the gold price went from $35, which was this fixed price, to a peak of $670 per ounce in 1980. So everything was rebalancing, everything was recalculated by the free market. So another thing that was happening in the 70s is that foreign countries were borrowing a lot of dollars to get things done. So that dollar-denominated debt grew rapidly around the world, and the US banks made a lot of money lending it out. So this is where the big bubble was forming. And eventually we hit the money and credit crisis of 1979 through 1982. And that's when the dollar and dollar-denominated debt were at the risk of not being accepted as a storehold of wealth already. So the confidence was being lost. There was high inflation and high interest rates, so it was a big political issue. So President Carter went and appointed Paul Volcker to fix this problem. So to deal with the inflation crisis and to break the back of inflation, Volcker tightened the supply of money and drove interest rates even higher. So this really squeezed people that were holding the debt. They had to sell their assets to pay for it. But it worked, and inflation rates started to fall, which allowed the Federal Reserve to start lowering the interest rates again. Now the people that were holding all the debt, they didn't get off scot-free. A lot of them went broke. So the 1980s was a decade where these debtors, especially the foreign ones who had all this US dollar denominated debt, they went through a decade-long depression and debt restructuring period. Now American banks were doing a lot better because again, we had the reserve currency, right? So the Federal Reserve would back up any of these banks. They would protect them from going broke. And this whole debt management and restructuring process lasted until 91. So this whole 71 through 91 cycle where we got off the gold standard and caused all this inflation and then the huge debt restructuring, it was all because of us moving into this new fiat system. So it was the cause of the inflation and gold exploding in the 70s and also all the restructuring that had to happen. The crisis in 79 through 81 and the 80s restructuring. Now from that 79 to 81 peak in the dollar denominated inflation and interest rates have only fallen from that period. You can see it in this tiny little graph right here. If I zoom in, you can see interest rates peaked right where we're talking about and have only fallen since, and now they're near zero. And of course, the Federal Reserve raised and lowered them during that time, which is the little spikes that you see, but overall the trend is lower because to get out of the next crisis, you gotta lower interest rates even lower than the previous time. So it's lower lows and lower highs. Now, after all the debt restructurings happened in the 80s, the 90s saw a new increase in money and credit because the cycle keeps going, right? And all that increase in credit led to the dot-com bubble. And then that burst, which led to the economic downturn in 2000 and 2001, which made the Fed ease even more, which pushed debt levels higher and kicked the can down the road to 2007 and 2008, the whole great financial crisis. But now in 2008, we had to do a little something special because we lowered short-term interest rates to 0%, but we needed more. So that's when the central banks started printing money and buying financial assets, QE. So Dalio classifies them differently. So lowering interest rates is monetary policy 1, and then monetary policy 2 is the printing. And the last time they had to do this printing was when interest rates hit 0 in 1933 and continued through the war years. It's that quantitative easing. And what happens? So by keeping interest rates super low and then printing money to buy assets like bonds, this pushes bond prices up. And if bond prices are pushed up, then what's happening in interest rates? They're falling even lower. So those people who used to depend on bonds to get some type of return, well, now what they had to do was borrow money, because borrowing money was cheap, and then put it in more risky assets like stocks. And this is why asset prices get driven up. This is the whole risk premium curve that we've talked about many times. If you can't get enough return from a safe asset like bonds, then you got to move further out on the risk curve. That's when you start looking at equities more. Investors increasingly borrowed money to buy assets that they expected to have greater returns than their borrowing costs. Recipe for bubbles. Now, eventually, once MP2 stops working, you got to get into MP3. 3 for the next crisis. That's monetary policy 3. That's where there's even more printing, but now you're giving like money directly to wherever you need it to go. So it's the whole helicopter money idea, direct transfers to people. And that's what we hit with the coronavirus, the CCPV. So because of that crisis, the Fed announced a massive money and credit creation program, along with programs from the federal government. So they included all the classic MP3 techniques, which includes that helicopter money I was talking about. Direct payments from the government to citizens. This is the same announcement that Roosevelt made in 1933. And remember, it's not just the US doing this, everybody is doing it. Europe, Japan, China, everybody. But the US doing it has the biggest effect because we are still the reserve currency, the dollar is. Because you can see the US dollar accounts for 55% of the world's international transactions. The euro is only 25%, the yen 10%, and the Chinese renminbi is only 2%. So like Dalio says, a reserve currency is probably the most important power to have, even more than a military power, because of this printing ability and the ability to get you out of these problems. Now we talked about before the 8 measures of a country's rising and declining power. Well, the reserve currency, which is measured by the share of transactions and savings in that currency around the world, that significantly lags the other measures of a country's strength. So in 1944, when the dollar was the reserve currency, the US had around 2/3 of the world's gold, and it also accounted for half of the world's GDP. Today, the US accounts for only 20% of the world's GDP, but it still accounts for 60% of the global reserves and about half of international transactions. So the dollar still reigns supreme, but it is the last thing to go. So if you look at the big cycle, this is how it looks. First, there's a new world order, like after World War II. Then you have a period of prosperity because no one wants to fight anymore. There's been massive destruction and everyone wants to just build and be calm. So there's that prosperity, but then eventually you get into the printing and you get the debt bubble and then the big wealth gap. Then the debt bubble bursts and they start printing more money and credit. Then there's revolutions and wars, which finally lead to the debt and the political restructuring. And once again, you got a new world order. So that's the big long-term debt cycle with money. Now, as we move forward here, Dalio, what he keeps focusing on, as you saw in this article, is the reserve currency. Who has it? And in his mind, the US is close to losing it. And then that power is going to move to China. And that bias right there is where we kind of look at it and say, hey, Dalio, are you objective about this? Or are you saying that because you have a big fund in China and a bunch of interests over there? In our research, at our macro research firm Macro Ops, we don't see that transition, if any transition, happening anytime soon. But the way Dalio is going to talk about it is like it's going to happen right now in the next few years. And he might be right, because obviously he's Ray Dalio, right? One of the smartest people in the world. But his judgment may also be clouded, considering his interests in China. Tough to say though, but that's why you need to take whatever he says with a grain of salt. Either way, his framework though for how all this stuff works is solid. And that's why we're going to continue to do these videos and learn more. So if you want to see them, make sure you subscribe. Also, make sure you take this training, because all the stuff we talk about in these articles is very long term. You know, we're talking 50 to 75 years here. And while it's good to know and good to know where you are in the cycle, you still want a strategy that's working right now and will continue to work in the future, because we're still humans living year to year. Like, we need our money now. We need to be saving now and compounding now. So this strategy is very simple, very effective, and it'll help you do that. And we'll teach you how to do it in this training. So there's a link in this video and down below in the description comments. Check it out. And make sure you subscribe for the next Dalio video. Do that and I'll see you then. Stay fallible out there. Bye.